Have you ever wondered how businesses determine when they will start making profit? It's like finding the moment when the scales balance perfectly, isn't it? This moment, my friends, is what accountants refer to as the break-even point. Now you might be thinking, what is this break-even point? Well, in the simplest terms, the break-even point is the point at which a company's revenues equal its costs. It's where the money coming in equals the money going out. It's the point of equilibrium, the zero profit point, where the business isn't making a loss, but it isn't making a profit either. Imagine a seesaw, if you will. On one side, you've got costs. These are things like manufacturing costs, salaries, rent, utilities, and so on. On the other side, you've got revenues, the money that comes in from selling products or services. When the weight on both sides of the seesaw is equal, you've reached the break-even point. But why does the break-even point matter? It's not just about balancing a seesaw, it's about understanding the financial health of a business. The break-even point helps companies plan their pricing strategies, make informed decisions about spending, and gauge how changes in the market could impact their profitability. For instance, knowing the break-even point can help a company decide whether to invest in new machinery that could increase production costs, but might also increase revenue. It can help a business determine how much they need to sell to cover their costs and start making profit. And here's another thing to consider. The break-even point isn't static. It can change as a company's costs or revenues change. If a company's costs increase, it will need to generate more revenue to reach its break-even point. Conversely, if a company's revenues increase, it might reach its break-even point sooner. In cost accounting, the break-even point is calculated using a simple formula: fixed cost divided by the selling price per unit minus the variable cost per unit. Fixed costs are those that remain the same, no matter how many units a company produces. Variable costs, on the other hand, change depending on the number of units produced. In summary, the break-even point is a critical metric in cost accounting. It provides a clear picture of when a company will start making profit, helping it plan its strategies and make informed decisions. It's the point of equilibrium, where revenues equal costs, and it's a key indicator of a company's financial health. So the next time you're thinking about the profitability of a business, remember the break-even point. It's more than just a balance on a seesaw. It's a balance on the ledger of success.